Monte Carlo simulations are widely used in risk analysis to help businesses make informed decisions under uncertainty. By simulating thousands of possible outcomes, companies can assess risks, optimize strategies, and improve financial planning. Why use Monte Carlo for business risk analysis? Business decisions often involve uncertainty. Monte Carlo methods help by predicting financial risks and investment returns, evaluating potential losses and market fluctuations, optimizing business strategies by simulating different scenarios. Case study, investment risk assessment. Imagine a company considering a major investment. Factors like market trends, interest rates, and competitor actions introduce uncertainty. A Monte Carlo simulation can 1. Model potential investment returns using probability distributions. 2. Run thousands of simulations to estimate best and worst case scenarios. 3. Provide decision makers with a probability-based risk assessment. Supply chain risk management. Monte Carlo methods also improve supply chain resilience. Businesses use simulations to model demand fluctuations and supplier reliability, assess the impact of delays and logistical issues, optimize inventory levels to balance cost and service quality, operational and financial risk analysis. Monte Carlo simulations assist in pricing strategy, simulating customer demand to set optimal prices, credit risk modeling, assessing loan default probabilities, project management, estimating timelines and budget risks, challenges in Monte Carlo business applications. Complexity of data modeling requires accurate probability distributions. Computational cost. Running extensive simulations can be resource intensive. Interpreting results. Decision makers need to understand probabilistic outputs. Conclusion. Monte Carlo simulations provide businesses with powerful tools for risk analysis. By modeling uncertainty and evaluating multiple scenarios, companies can make smarter, data-driven decisions to navigate financial and operational risks effectively.